With deficits ballooning, the debt ceiling looming, and the US dollar under pressure, how dire is the situation? Earlier hopes for a lower US fiscal deficit under the new administration have faded in light of the latest version of the Big Beautiful Bill. If the current legislative package passes largely intact, federal deficits could rise from an already elevated 6.3% of GDP last year to over 7% in 26 and 27. This ongoing fiscal pressure is one reason why 30-year treasuries have recently climbed above the 5% mark. Higher bond yields are adding to the fiscal challenge. The net cost of debt against government revenue has risen above the 12% mark, and it's likely to head higher. As debt and yields rise, the risk is not just further rating downgrades, but reduced global investor appetite and a further rise in long-term treasury yields and tighter financial conditions for the US economy. While the introduction of specific measures of financial repression can create short-term trading opportunities, long-term wealth preservation still hinges on global diversification. We recommend exposure across asset classes and regions with an emphasis on real versus nominal assets and companies that are able to pass on higher inflation. Gold, inflation-linked bonds, at least initially, real estate and select equities with pricing power can help investors to protect purchasing power. In summary, the US fiscal outlook is challenging, but not at a breaking point.